So let's say that I gave you £10,000. It's sitting right there in front of you today. It's completely yours. But there is one stipulation. You have to put it somewhere and you cannot touch it for 20 years. No checking, no fiddling, no bailing out, no selling when things get noisy and messy. Now, let's also say that I give you 3 options as to where you can put that money. The first one is a gold bar. The second one is shares in one of those jazzy tech companies that is all over the headlines every other week. Or you can go for a boring, globally diversified index fund, which is just a fund that invests your money and spreads it around across a tiny slice of thousands of the world's biggest companies. Basically just the whole of the stock market, right? Now, I want you to pick one of those. Do it in your head right now, deliberately. I want you to genuinely pick one and be honest with yourself, because whichever way you have just leaned has told you something quite uncomfortable about whether you actually understand how wealth gets built, or whether you've been doing something that looks like investing, feels like investing, but is something completely different altogether. Look, I've been a financial advisor for 15 years and I've worked with hundreds of people, and the portfolios and the investments that I see are nearly always the same, right? Few big tech names, individual stocks, some gold coins or something else like, some sort of collectible or whatever it is, but a crypto, and then probably a handful of funds that they've picked because they've had a brilliant few years in the past 5 years. And they sit back and show me quite proud of it, genuinely believing that they are investing, when what they're doing is playing a kind of very slow, very expensive game of like musical chairs, essentially. And the music's been going so long that they've kind of forgotten that they can actually stop. And almost none of them know the one law, the one thing, the one positive aspect that decides which side of that line that they end up on. It isn't complicated, but it is the whole difference between the people who get rich by random accident and then also end up usually giving it back to the market, and the people who build wealth so predictably it's almost dull and boring to watch. It is called positive expectancy. Let me explain. So let's go back to that gold bar, right? Let's say you chose that one. Let's say that you buy it for £10,000. You put it in a drawer and you leave it alone for 10 years. The question is, what does it do in that drawer? Well, nothing, right? It doesn't pay you anything. It doesn't grow. It doesn't invent a new revolutionary product or hire a better management team or open up in a new country. It just sits in the drawer, in the dark, being gold, right? The only way that you can ever make a penny out of that gold bar is if in 10 years from now, you find somebody willing to hand you 15 grand for that identical lump of metal that did nothing for you for a decade, and you're just hoping that someone else will buy it off you, which has a name, by the way, the greater fool theory. You've probably seen this play out quite a few times, right? With lots of different things. But the key one to remember, I remember where it was all went absolutely crazy, was when Kanye West's Yeezy trainers first came out. So it was all like limited edition, sold out in like 5 seconds, whatever it is. And then within an hour, there's someone online asking for like 3 times the price of them. Nothing fundamentally changed about that shoe in an hour. Somebody just wanted it more than you did. And that is the whole engine, right? Your profit doesn't come from the thing you own. It comes from finding somebody more optimistic than you were when you bought it. Just someone that's willing to buy it off you at a higher price. The same goes for loads of different things, right? Bitcoin, art, vintage Pokemon cards, whiskey, all of it, right? They are all what we call non-productive assets. They don't generate anything on their own. They don't make any profit or generate any cash flow. They just sit there. Now, don't get this confused. That doesn't mean that you can't make money out of them, because obviously people do. And I'm not saying that at all. If you're an expert in these things, then fine. But what you're doing there is trading. You're not investing, you're trading. You're hoping to buy it at A and sell it for B, which again, it's not a problem. It's fine if that's what you want to do, but it just isn't a reliable, consistent way of building wealth. And those two things get completely mixed up constantly, right? So compare that, if you will, to say a farm. Now, with a farm, you buy the land, you plant the seeds, the crops come out of the ground, literally grow from seeds, and then you sell that at harvest, and then you do exactly the same thing next year. The farm simply pays you for owning the land and existing and, of course, being run properly. If the value of that land of the farm dips next year, it's annoying, but the wheat still grows, right? It's that constant growing of a yield, of a thing, of a cash flow that didn't exist previously. So a buy-to-let property works kind of by exactly the same logic, doesn't it? The rent comes in, and you've bought the property and the rent comes in regardless of the value of the property itself. You're not necessarily always relying on capital appreciation. That is a productive asset, something that generates things, right? Profit, dividends, rent, growth. Then that's completely ties in to this notion of positive expectancy. The mathematical probability that something is going to be definitely worth more in 10, 15, 20 years time without you needing to do anything with it. No timing, no second guessing, no being clever, no trying to find someone else to buy it off you. Just the fact that because an asset has a cash flow, you can actually put a value on it. There's a value on that asset that is based on that future cash flow, right? It's really simple. It's the 101 basis of any investment. Now, the reality is that most of us can't go out and buy a farm, right? And being a landlord is a job with a lot of money and a lot of unpaid Saturday mornings attached. So the most accessible, productive asset for normal people with a normal amount of money is equities. The stock market, in other words, right? Actual slices of actual business going out and making actual profit. The magic, the thing that didn't exist before. And now, you're potentially nodding along with this point, thinking, yeah, okay, look, I don't own any Pokemon cards, mate. I own shares. I'm definitely on the right side of this argument, right? Well, this bit is where I've watched more money disappear than anything else, right? And I still see it most weeks in my one-to-one coaching because people assume that owning individual company shares, Apple, Tesla, one of the big banks, whatever, is the same as owning a productive asset with positive expectancy. It isn't. Not even close. If you put a gun to my head right now and ask me to bet on whether Tesla, for example, will be higher in 10 years' time than it is today, there is absolutely no way I'm taking that bet, okay? Because I genuinely do not know. Nobody does. And you watching this right now certainly do not know either, despite what you think you might. I remember sitting with some clients and we were talking about this concept. And I remember them telling them very, very clearly, telling me very, very clearly about 2008. So it was before I was dealing with them. Now, at the time, their pensions were absolutely stuffed full of like bank stocks. They just really loved bank stocks. The kind of institutions that had stood the test of time for centuries, right? The names that your grandparents probably banked with. They were on the high street of every town. Now, these guys, they weren't reckless people. That's the thing. They'd gone out of their way to avoid anything that looked racy. They had bought the most boring, most reliable, most obviously safe thing on the board, banks. And within a few months, within 2008, they were nearly absolutely wiped out. 2008 rolled around and nearly 10% of their portfolio just evaporated overnight when these banking stocks collapsed. Absolutely brutal. Now, of course, the rest of the market suffered too, but theirs was catastrophic. And that's the bit that I want you to sit with, because those guys weren't gambling, right? They were being careful. Careful just wasn't the thing that was protecting them. See, capitalism is brutal like this, right? Companies get mismanaged, they get overtaken by other competitors, they get left behind by new technology, or by simply people deciding that they fancy something different now, right? It happens all the time, which is why an individual company, however big, however old, however seemingly strong and not going anywhere they are, does not have positive expectancy. Now, let me say that again clearly, okay? Individual stocks, no matter what you think, do not have positive expectancy. In fact, over a long enough time frame, every single individual stock will go to zero. Doesn't matter how stable or safe they are today. So the question I always get at this point, almost always, right, is, okay, fine, I'm going to stop picking individual companies, individual stocks. I'm just going to buy the S&P 500 or the FTSE 100. That's hundreds of companies at once. That's well diversified, right? Job done. Well, let's see, because this is the bit that even catches out people who are often very financially literate. If you'd put your money in the UK stock market, the FTSE 100, that is the 100 biggest companies in the UK, on the 31st of December 1999, you'd have sat there and watched it do essentially nothing. It took the best part of 2 decades before the FTSE 100 meaningfully and permanently got back above where you'd bought in. 20 years of being patient, not panicking, doing everything right and going absolutely nowhere. And guess what? The S&P 500 isn't immune to this either. Investing at the start of 2000 and by the end of 2009, your annualized return, essentially, that's the average yearly figure once you smooth out all the ups and the downs, was somewhere around -1% a year. A whole decade where your money is essentially going backwards, not even inflation protected, backwards. They call it the lost decade. And honestly, that's probably the flattering version of that story, because it doesn't count everybody who kind of gave up somewhere in the middle of it and swore that the stock market was no good and it was all rubbish. Because buying the S&P 500 is just a bet on the 500 largest companies inside one country. Now, that's miles better than picking one individual company, obviously. I'm not going to pretend otherwise. But you're still betting that one country, one political and economic engine never stalls, right? And you're doing it with a 20-year lock-in. You're making an active decision. See, geographical indexes like the S&P 500, like the FTSE 100, do have greater positive expectancy than individual stocks. Obviously they do. They're more diversified. But it's still leaving you exposed. And I'd still probably not take the gun to my head bet of, will the S&P 500 or will the FTSE 100 be higher in 10 years' time? Look, probably is the answer. Probably it will be. But I'm not as confident in that as to what I'm about to show you next. So what does have positive expectancy then? What would make me take that gun to my head bet? Well, it's the asset class itself. It's global equities, something like the MSCI World Index, which captures thousands of large and medium-sized companies right across the developed world, all in one go. It's basically just the best way to get exposure to the complete asset class of equities. No decisions, no active decisions to go to one geography or one sector or one individual stock. With a global index fund, you're not backing one individual horse, right? You're not even backing one individual stable. You are backing the entire racetrack, right? That's the whole point of this, which is the answer to the question that I opened with, by the way. Not because the boring fund is exciting, but because it's the only one of the three where you aren't relying on somebody to turn up later and take it off your hands and buy it off you at a greater price, or by gambling or by trading. So ask me whether global equities, the asset class of equities, the stock market, will be higher in 20 years' time than it is today, and the answer is yes. Obviously yes, every time, even if it's just in line with inflation. And not because I'm some eternal optimist. You might have actually picked up from this channel by now, but I'm actually a very skeptical person. But because of what would actually have to be true for it to be wrong. Human innovation would have to stop. Population growth would have to reverse. Companies everywhere, all at once, would have to forget how to make a profit. Capitalism would have had to have fallen. And if all of that happened, then the world has fallen over completely, and then your 10 grand is probably the least of anyone's problems, right? That's the whole thing. You're capturing the background hum of human beings just getting on with it, essentially. So the question is then, well, what do we take from all of this? What should we be actually doing instead? Well, first, stop predicting, okay? Stop caring about what the Bank of England does next, what the latest inflation number was, or what your brother-in-law's mate heard about lithium. Guessing short-term moves in the market is a fool's errand. And the good news is that I've just let you off and given you an excuse to not have to do it. Then you stop trading. No more buying at $1,000 and hope that it's 1,200 by March. It eats away your evenings, and every little round trip takes a little bite out in terms of cost and tax, whether you got it right or wrong. Then automate it, right? Which is the dull bit that does most of the work. Invest in something tax efficient like an ISA, which is an account where any growth or interest that you make is completely free of tax. Or your workplace pension, even better. You set up a direct debit, and every month you buy a low-cost global index fund if that suits your risk profile. If it doesn't, something like a passive multi-asset fund if you wanted to take a little bit less risk of your money than just having everything in equities. And you keep contributing, whether the news is screaming recession or screaming boom, right? And that's the real reason to automate it, by the way. It doesn't have an opinion. The direct debit doesn't read the news, right? So on the mornings when you would have talked yourself out of it, it just goes in anyway. And then you get to be bored, which sounds like a downgrade right up until you've actually felt it. Because when someone at a dinner party is telling the table about the 300% they made on some dog-themed coin, you'll feel a little pull in your stomach. Hang on, should I be doing that? And then you will feel that pass, let me tell you, because you know exactly now what you're looking at, right? When this guy's telling you something. He's at the roulette table telling you about a good spin. He never, ever will tell you about the bad ones, obviously. The reality here is that this is just one of some really key fundamental lessons that I've learned over my time helping people invest and grow their money. Thankfully, in this video here, I've outlined some key critical lessons that I've learned throughout the last 15 years. And I think it's probably the next logical watch after this video. So give it a click and I will see you there.